This is not about speculative trading in silver. This is literally about how much silver and in what form can and will move around the world. But meanwhile, there'll be these moments of volatility, which we're going to see in the markets. We're going to see these 400, 500 point changes in the S&P, for example, again this year, maybe even more acute as we see different movements. And those are where you're going to see the squeezes in the commodities, and you're going to see the tension and the volatility in geopolitics in general.
And how would that impact financial markets? It's going to be a dramatic year of a lot of wild changes. Brace for imperialism around the world, supply chain disruptions, even supply chain crises. How will all these geopolitical developments impact the financial markets and economies? We'll find out with our next guest, Nomi Prins, founder of Prinsights Global, geo-macroeconomist, and best-selling author of Permanent Distortion: How the Financial Markets Abandoned the Real Economy Forever. This video is sponsored by Kalshi. It is a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here. When you sign up for the first time, you'll get $10 on your first $100 deposit. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. More on that later. Welcome back to the show, Nomi. Good to see you again.
Good to see you again, David, and Happy New Year.
Happy New Year to you as well. I'd like to start by talking about global financial distortions. It seems that we're entering an age of not just protectionism, but extreme, isolationism of trade. Not extreme yet, but heading in that direction. China just banned, or restricted rather, the export of silver. And now with Trump seizing Nicolas Maduro, the Venezuelan president, and threatening, by the way, to do the exact same to Mexico and the rest of Latin America, we're now probably seeing the U.S. take control of the entirety of South America's financial as well as natural reserves, potentially. This could mean a lot of different things for global geopolitics, including the restriction of exporting certain critical minerals and oil products to the rest of the world, hoarding it for the U.S., and potentially more retaliation in kind by trading partners, especially China and Russia. Let's start there. What are the major distortions that you see in this year, 2026?
Yeah, it's going to be, as you've outlined some of those things, David, such a critical year for the intersection of geopolitics, sovereignty from a nationalistic perspective, particularly with the U.S. and China going head to head, and not discounting where Russia is because of the natural resources that they have and their alliances in the BRICS community and with respect to China and so forth. And it follows from a major distortion last year in 2025, which saw natural resources, hard commodities, not oil, but many other hard commodities gain in value and gain in focus by governments around the world. We saw the United States government invest in a 10-year higher than market prevailing prices floor for rare earth minerals with an investment in MP. In the United States. We saw them put $80 billion in the pipeline for uranium processing facilities to try and get sort of downstream of the uranium enrichment and energy processing. And we're seeing other governments create these sort of strategies as well. And as you mentioned, China, who is currently in a one-year détente with the United States with respect to, they say, raising additional restrictions on rare earths, which they process 90% of in the world. But that could change. I really feel that a lot of the agreements, to your point about nationalism and even going on from last year's tariffs that came out and were such a sort of volatile wand in the world from the United States and the retaliations from other countries, I think we can see a lot of push-pull on even agreements and numbers that were in place by the end of 2025 in 2026, specifically because of this frenzy of geopolitical gathering of natural resources. So when we look at the U.S. and Venezuela, it's not just an issue with the president of Venezuela, or the former president of Venezuela. It's an issue of oil, and it's an issue of basically commanding more of the global supply of oil in order to have more control over the prices. And of course, for oil, the U.S. has a lot of the refineries and production in place. We don't have that for a lot of the other critical minerals that we use and will continue to use for electricity, defense, and so forth. So the distortions that we're seeing in this world today are very, very geographical. They are very related to structural deficits, not just in where supply is and where it comes from and how it moves, but also how it can be refined and processed. And we are going to see many more of these movements throughout the world from a national government perspective. And sort of by extension, the companies that are involved, whether they're from mining through production throughout the world, and how they position themselves in this alignment.
Well, let's just focus on that for now and move on to another topic later. China's restriction of silver exports. This is, this came in a few weeks ago. It's been well telegraphed. The silver market, we'll talk about the silver market's reaction, but basically, even CEO of Tesla, Elon Musk, said this is not good. Silver is needed in many industrial processes on X. And can you just shed some more light on the agreement that you know about so far and what this may mean for the silver market?
Yeah, so first of all, the silver market has been running what is now moving into a 5-year deficit in terms of current demand, not even future expected need for silver in terms of infrastructure, in terms of wealth gathering, and in terms of possible reserve openings from a central bank perspective to include silver alongside gold as a tier 1 asset, which we will be looking at throughout this year. And so what Elon Musk has said and what other industrialists know is that silver is intrinsically necessary to create new infrastructure, new industrial capacity, new electric capacity, new everything. And so China, who processes quite a lot as well as exports quite a lot and uses quite a lot of silver, at the end of last year said that as of January 1st of this year, which they did, they would restrict some of the silver exports, and particularly processed silver exports from their country. And what this creates is an actual supply deficit. This is not about speculative trading in silver. This is literally about how much silver and in what form can and will move around the world. And as I alluded to before, I think this was a very targeted action for China to be able to really ring fence a very important commodity, which silver is, after having agreed with the U.S. towards the end of last year to wait until November 2026 to do the same again with rare earths. And so I think what we see from all of that is that silver, and we consider silver to be the number one sort of commodity with upside for this year, because of the structural deficit, because countries are fighting for it, because processing happens in only certain areas, because there are no new mines coming online for 2 years. There is only silver that's currently out of the ground, which again is already at a deficit. There is silver in certain mines, for example, in Argentina and Morocco, and countries that are outside of sort of China's purview, and outside of where we already see silver production and mining happening from the larger silver companies like outside of Mexico and so forth, that's even available to head into this deficit. So this deficit is going to grow because the sheer volume of silver that can be produced is effectively not going to be additive. And China knows this, and what China is trying to do is both stockpile their silver, stockpile their processing, and I believe push for, as they did with gold, in the wake of the 2008 crisis, in the wake of COVID, in the wake of the escalation of the Russian invasion in Ukraine, create more of a gold reserve in their central bank and throughout their entire banking system and retail investor system. I believe they're going to do the same thing with silver and push from sort of the back end of what they can do with respect to the BIS and other central bank regulations to include silver not just as an industrial commodity, but as an official monetary commodity. So silver is incredibly, incredibly pivotal this year for many, many reasons. And that's going to force a squeeze in prices and an acceleration of miners in the pipeline to move their mines forward.
Yeah, it's already up more than 100% over the last year. Specifically, well, more specifically, it's up 160, 163, 164%, 150%. So Nomi, what do you mean by monetary metal for for silver? How would that work?
Well, so right now, gold is considered a tier one or a fungible asset for a central bank to hold on its reserves, to basically hold in its books. And what we've seen over the past few years is the movement of central banks in the BRICS in Eastern Europe and Central America and South America, in the Middle East, moving out of treasury and US denominated reserve assets on their books into gold. But we're still actually below the gold percentage of reserves that we were at the beginning of the post-financial crisis period, which had a different reason for it. Then it was about sort of hedging banking risk and hedging dollar risk and hedging the Federal Reserve risk. Now it's got a whole bigger movement in terms of gold. So when we start to look at, and that's why gold will continue to appreciate and accumulate as well. Silver, though, is not officially considered as a tier one asset right now from the standpoint of the BIS, the bank that actually monitors central banks and all the activity and sort of creates regulations and works with other banks throughout the world. And though it has been in the past, in the movement towards the Great Depression, for example, and in the early 1900s, silver was accumulated as for central banks that existed and for ones that were in their formative stages as a reserve asset. And so we can see, I think, a historical movement back to the future of potentially including silver as that kind of an asset. If that happens this year, I don't know, but I believe I know those discussions are being had, and I believe they will accelerate because of silver's past and current role as a hard asset currency dimensional asset, but also because it's cheaper than gold, also because of how it geopolitically can back currencies and create more of a sort of neutral environment for fiat money versus hard assets in the world. So that's where I see it potentially becoming a reserve asset. And it's not going to become one, it's going to be discussed. And I think that will create another move for silver, or boost for silver.
The squeeze that we've seen already so far, how much further can it go this year, especially going back to what I said earlier in the beginning of the interview, especially given what's currently happening in South America and to some extent around the world? How will China retaliate, or not retaliate, but respond to the seizing of Maduro? Will we expect more restrictions of rare earth minerals exports and critical minerals exports from China, and potentially even restrictions of refined minerals, which, by the way, as you know, China is the world's #1 refiner of copper, for example. And so if they stop exporting that, we have no capacity in the West to immediately catch up. It takes years, not overnight, to build a smelter.
That's correct. And we don't have that capacity in the United States. We had one smelter expand last year. We don't have new ones in the pipeline, certainly not new ones that are going to come into play this year. And that's exactly right. Copper is and was even last year something that China was adding, was stockpiling, is one of the main processors in the world. And copper is definitely in their sights because they're also continuing to build their own infrastructure, not just within China, but within all of the Asian region, throughout the BRICS. And copper, and the refined copper component of that is very much a strategic commodity for China and will continue to be so. So when you look at what happened in Venezuela, it was pretty much oil commodity based. But also, and this is something I personally believe about oil looking back at history, we're kind of looking at the 70s here now in terms of the squeeze on assets in general, the difference being, and why it's so much more potent for most commodities, is that you do have China processing the lion's share of most of these commodities. And yes, they can curtail that export or make it very expensive going forward. And I do believe we're going to see some tariff wars as a result of what happened in Venezuela that we thought we had put to bed in 2025 because of that. Whether they happen in rare earths, because there's this sort of agreement with the United States that they won't happen until, they won't be reassessed to happen again until November of 2026. I don't think that necessarily that's going to stay binding all this year. I think we can see more commodity wars in the rare earth space. I think this export control over silver can expand to copper, and I think we can see that as well. And again, that's going to create a lift to these commodities. And I think the United States is going to continue to to put federal money or public money and have it match with private money into processing, into uranium enrichment, into potentially smeltering plants, or at least augmenting the acceleration of them in the United States to be able to have some independence on the processing side, which China has had. And of course, in the 70s, we saw massive inflation, which we don't really have now. It was kind of a last year story, 2.7%, 3% inflation's not that big a deal. And oil prices dropped last year. Every other commodity that we're talking about that China can control, which is not oil, has increased. And so even though the United States has basically gotten now a whole new component of oil supply, oil isn't really the issue here. It's not the geopolitical issue that all of these other commodities are. They are more important, and therefore they will be more squeezed. I think oil is pretty plentiful throughout the world. We have the refining, we have the production, and I don't see oil prices rising too much because of these movements. But I do see other commodities that China can control rising, and I do see more stockpiling across BRICS Plus and across non-Western and even Western countries to get their own share of processing, refining, moving more forward, and also commodities in their countries, or alliances for commodities to be freely available.
What do you think is going to happen to global markets this year? Are we going to see a continued bull run and sustained momentum? Or are these supply shocks going to really throw things off kilter?
Well, I think if we look at where commodities ended last year and where net of oil and net of currencies like the dollar, but where commodities ended last year is that they vastly outperformed the market. And on an individual basis, silver compared to Nvidia, they vastly outperform the bigger players in the market. And if you look at miners relative to the commodities, in some instances, they outperform the commodities, which outperform the market. And so the market went up. It went up because there is still, and there was, interest rate reductions. There was a bit of an inflation reduction. I think it's pretty stable now in the twos. Whether it gets below 2 or above 2 or 3, it doesn't actually really matter. It's pretty similar. And we're going to have a new Fed chair in May, and whoever that is, as it's going to be appointed by the Trump administration, confirmed by Congress, which is not right now controlled by the Republican Party. So there will be, it's not a political statement, it's just a question of numbers. There will be a confirmation of whoever's put up will have a bias towards easing. And in general, the stock market, the equity market, the tech market, the components of that market do respond very well to rates going down or quantitative easing or bond buying, because debt is phenomenal right now. Obviously continues to blow past records, gets done by the Federal Reserve or the Treasury Department is also just starting ways of buying kind of back treasuries as well to try and take some of that supply out of the market, which boosts demand, which reduces rates, they hope, in the long end, which didn't happen last year. If any of all of that happens again this year, we're going to see the market rise. But based on all of what we're talking about with respect to key commodities that are strategically both necessary and in finite supply from a in the ground through a processing or full-on downstream perspective, they are going to outperform the market again. And I think they're going to outperform the market more significantly this year in 2026 because of everything that we're talking about, not least also because we're heading into an election year for our midterm anyway for the United States, which always creates extra volatility. We are going to see, I think, them outperform by more the main equity market, the S&P did it out.
Let's take a look at monetary policy. This is from Cauchy. It's a prediction market, one of the largest ones in the United States. Fed funds rate after January meeting. So traders are predicting above 3.25, 97% chance, and then above 3.5, 90% chance. So it doesn't seem like traders are predicting that there's going to be extreme dovishness, at least not yet. What's your view?
No, I agree with that. I think in general, the Fed, or at least this Fed, doesn't tend to lead the year with any decision or any real movement. I think we can look at some of what's going on, for example, in the reverse repo market with banks. We have seen more liquidity kind of pumped into the banking system, which is generally a precursor for potentially some form of quantitative easing in the long end, even if we don't see rate cuts immediately at the first FOMC meeting out the gate in the short end. So I agree that if we see 25 basis points, that's a lot. It's kind of a continuation of last year, but I think it's more that we're looking for ongoing dovishness more so as we get to that new chairperson at the Fed event. And so I think markets right now are just kind of waiting on that expectation because there will be more discussion of that and more movement on that as we get to May. That's on the short end, though. On the long end, I do think that the Treasury is going to become more aggressive with its own form of rollovers or buybacks. And I do think we're going to see QE kind of creep up or stay the same, at least in terms of the Fed's current asset book size right now anyway. And so there is an easing kind of mentality in the market, but it's not officially connected to rate cuts in January. But I think we will see expectations and the actual turnover of those expectations become lower rates and become more QE and become more Treasury-based actions on getting more buying on the long ends as we head towards May. And then from May on, I think we'll see much more of that.
Can we see a scenario in which commodity prices, due to the supply squeezes that we're talking about around the world, could in fact reignite inflation beyond the Fed's initial estimates, therefore making them more hawkish than we expect?
That's a really interesting question because if we look at 2025, we did see all of these main commodities rise. We did see silver rise by 140, 150%,
Yeah.
depending on which number you use. We did see gold rise by 65%. We did see platinum, which is a very much a component of hybrid vehicles for retail as well as for commercial and defense purposes, increase by 130%. So we've seen the main assets. We've seen copper increase by 40%, but again, I think copper is going to be a standout for this year because of what we're talking about with China and with needs and more building. And it is on the critical minerals list this year as of November, and it will be as silver just popped onto it. We saw the movement in commodities, and inflation pretty much stayed the same. Now, this is how I view inflation, whether it's 2.4 or 2.5 or 2.7 or 2.3, it's pretty much the same. We're more or less seeing prices, again, on average, because any one commodity can squeeze any one product up specifically at any moment, regardless of what overall inflation is. If all of a sudden all coffee stops, we're going to see higher prices, when we go to buy our coffee in the morning or when we go to buy beans at the store. But by and large, if we look at the average stats, your core CPI and so forth, we're pretty much in the same inflation band after a massive year for all of the major commodities as we were at going into this year. And so can prices go higher if there's more tariffs and there's more squeezes and there's more export constraints on physical assets and their refined components? Yes, they can. But is it going to create this massive additional upside in inflation? No, what creates inflation in these prices is already kind of moving in the system. It will keep inflation from going down significantly. But barring, again, individual squeezes a month here, a month there, certain tariffs that come out, certain controls that get announced and then renegotiated backwards, and all the things we're going to see, it's not going to, I think, fundamentally change our inflation picture.
And similar question on the outlook for the markets overall. S&P closed by end of 2026. Traders are predicting more sustained momentum, slightly more bullish. So 75.99, 7,400 points to 75.99 is roughly 12%, 10% higher than current levels. So not a huge year for markets, just continued momentum. What could derail this momentum, Nomi? Or maybe you're on the same page.
I see this momentum as well for the reasons, or some of the reasons that I've said before, which is that we do have, this sort of easing mentality that if it doesn't happen at, the first start out of the gate in this year, it's going to by the time we get to May and so forth. We do have an election coming up. There's going to be, I think, more geopolitical movement, whether it's another country next to Venezuela or so forth, that's going to create some noise. And we could see because of that dips in the market, but I do see that momentum. I do see it slower in the overall S&P, again, not in commodities, than it was this year. We finished the S&P 500 in 2025 up about 16%. So for it to be around 8 to 12%, let's call it 10% over 2026, I think is very reasonable given all of those factors. And again, we can see and we will see dips along the way because there is a lot of potential geopolitical volatility that is going to come into this market this year. But also, again, and just to repeat, I think that commodities will outperform to the upside relative to how they did this year. So I do see these markets going up. I do see a lot of volatility. I do see commodities outperforming the S&P by a wider margin in the key commodities as once we get to the end of 2026 and move through this year.
Okay. If you were to rewrite your book, Permanent Distortions, this year in 2026, factoring everything you've witnessed in 2025, what would you change in the book?
That's a really interesting question, too. When that book came out, inflation was really high. It was 7%. We had just come out of COVID. We were talking about a lot of supply chain disruption, and we didn't yet have the tariff component of that. We were still in administration, which was doing some tariffs, but they just weren't getting a lot of headline attention. Like that, there were things in rare earths because it is such a critical mineral. There were permanent magnet tariffs. There were EV tariffs, but it just didn't have the same sort of attention. And I think I would have perhaps written more on that. And I did talk about protectionism in that book, but perhaps widen that a little bit more. What I did talk about in the book was more continued strife that would open up in the world from just a demographic and sort of jurisdiction. I think I would have continued to dive a bit more deeply into that, as opposed to just civil unrest, actually more commodity unrest. But also, and I don't have it in front of me, David, because I just started writing another book for this year on everything we're talking about. I'm sure that will shift as I write it and as the world evolves. But one of the last things I said in the intro of Permanent Distortion was that we were going to see, and this was 3 years ago, we were going to see money move in a different way and move towards hard assets. And we have seen that come into play with gold becoming a 5 to 6% asset now in terms of central bank reserves, just above the euro and below the dollar in terms of total volume of reserves, potentially with silver coming on the back of that, and so much more fighting for those commodities. So I think I might have had a bit more of a forward perspective on that versus just opening the idea to that, knowing what I know now. But the idea was something would happen that would move us towards hard assets, or multiple things would happen. And I might have delineated them a bit more in a fine-tuned manner, but I do think we're seeing that. We're going to continue to see that. There's
another emerging threat, or I guess theme, that people are concerned about, which is the return of imperialism in the West. So with Trump taking over Venezuela, it's unclear whether or not he's going to, or who is going to take over Venezuela after this. Now he's threatening to do the same thing with the rest of South America. He's threatened to take over Greenland. This is an issue. This is a statement issued by Stephen Miller, Homeland Security Department. Now people are taking his threats of taking over Canada more seriously, and Saudi Arabia taking over Yemen, China threatening Taiwan, Russia potentially controlling the rest of Ukraine if maybe they're going behind the scenes and making this pact together. We don't know, but it seems like people are more comfortable, or I guess accustomed to the notion of just countries losing sovereignty overnight, which is exactly what happened last week.
It is. And
yeah, I'll let you discuss this. Yeah.
Yeah, no, sorry to interrupt, but absolutely, because we already have seen the U.S. basically take over Venezuela, or effectively that's sort of what's going on from the standpoint of who's going to control it, who'll be in leadership, if the U.S. is going to be there. And again, what happens primarily to their main commodity, which is oil. And if we look at all of these other potential situations, if we look at Russia's general escalation of its invasion into Ukraine after what happened in Crimea in 2014, and sort of staying in a position where it can not just try to reacquire parts of Ukraine, but look at Ukraine's natural resources. Look at, and they're very, very, very not extracted yet, but look at its rare earth potential. Look at its uranium potential. Look at its wheat potential, right? So there's reasons that are very commodity based for these things to be happening. Saudi Arabia, whether that happens because it pretty much that's a neutral on commodities, I don't know. But I think where we have the most risk or potential for those things to happen more so this year, you can follow the commodity chain and you can follow the processing chain. And so I think we will be seeing more of that. And those are where you're going to see the squeezes in the commodities, and you're going to see the tension and the volatility in geopolitics in general.
And how would that impact financial markets?
Yeah, so again, that's where we'll see the ups and downs. Like, for example, we saw the dollar, which had weakened massively throughout last year, by 10%, which was a pretty big weakening in terms of the overall recent years for the dollar. We saw it bump up a bit. We saw it sort of increase in its value, I think, for a very short period of time. I think it will decrease again because of rates, because of other issues. But what we see in the interim is we'll see the countries that are enacting, and that is mostly United States right now, these expansions of their own footprint, again, along the commodity lines. We'll see the volatility, we'll see the dollar increase, and then it'll, I think, decrease again, and the commodities will pop up again. But meanwhile, there'll be these moments of volatility, which we're going to see in the markets. We're going to see these 400, 500 point changes in the S&P, for example, again this year, maybe even more acute, as we see different movements in terms of countries moving into other countries, or more tariffs or agreements being shunned or dissolved along the way. So I think the impact on markets will be volatility. I think in general, this is where commodities do have a bigger upside potential when those dips inevitably occur this year, based on these volatile movements, based on these geopolitical moves. But I also think we're still going to end the year mostly up, just more so in hard assets versus financial assets.
Well, Nomi, tell us where we can find you and what you're working on now in early 2026.
Thanks. Yeah, the best place to find all my current thoughts is on our Substack, is at prinsights.substack.com, where we run premium portfolios on opportunities or investment methods that people can consider to take advantage of all of what's happening in the world as it unfolds. But yeah, I just encourage everybody to check out that Substack, that newsletter, and our portfolio products on it.
Okay, good. We'll put the links down below, so make sure to follow Nomi. Thank you again, Nomi. We'll see you again soon. Take care for now.
Thank you so much.
Okay, thanks, Nomi. Don't forget to follow Nomi. Links down below. Like this video and subscribe to the channel if you haven't already. And don't forget to use my code LIN, L-I-N, when you use and sign up to Kalshi. First-time users and sign-ups will get $10 on their first $100 deposit. Link down below, or scan the QR code here.